But oftentimes it's like on the back of, oh God, look at what a mess everything is. It's rallying because of geopolitical stuff, or it's rallying because the economy is going to the toilet and we know no more QE is coming and all the $2 trillion in new debt. All these things are like, oh, I know that's why I bought it in the first place, but God dang, I hate, the typical groups, the typical funds, the home office accounts and stuff like that trade gold futures, they're already long. And the short side has been reduced heavily. And so there's just not a lot of buying pressure, new buyers and stuff to follow through and keep chasing price higher. And so that's kind of why and that's, I guess, to me, that's a real world application of that COT report, which you can't really use to trade, but you can use if you understand where price was and can correlate that with COT positioning, and then you can kind of begin to anticipate what might happen next. And so that's kind of why gold is kind of stuck where it is, even though it is $2,550.
Despite talks of rate cuts and broader economic changes, there hasn't been enough buying pressure to push precious metals prices higher. According to market analyst Craig Hemke, the Commitment of Traders report shows that many traders are already holding long positions in gold, meaning fewer new buyers are entering the market to sustain a rally. Hemke points out that banks play a crucial role in shaping the gold and silver markets, holding large short positions in both metals, especially silver. These short bets limit price growth as they signal expectations that prices may fall or stay flat. Hemke notes that this is a key difference from 2011 when silver prices surged due to a short squeeze. Today, banks like JP Morgan have large reserves of physical silver to back their positions, reducing the risk of being forced to cover shorts quickly. Silver has lagged behind gold due to weaker demand, Hemke explains. While central banks have significantly increased their gold holdings, silver has seen little interest from either retail investors or large institutions. In 2023, investment in gold reached $128 billion, compared to only $6 billion in silver, reflecting lower demand for the metal. Looking ahead, Hemke believes silver's price could rise if industrial demand, particularly for use in solar panels and batteries, picks up. However, for now, silver remains stuck between gold and other industrial metals like copper. As for gold, Hemke suggests its movement will depend largely on central bank activity and broader market conditions in the months ahead. Now, we'll show you the best clips of the latest interview, but first smash the subscribe button, turn on notifications, and check our description for full vid credits. Enjoy the episode.
The typical groups, the typical funds, the home office accounts and stuff like that trade gold futures, they're already long. And the short side has been reduced heavily. And so there's just not a lot of buying pressure, new buyers and stuff to follow through and keep chasing price higher. And so that's kind of why and that's, I guess, to me, that's a real world application of that COT report, which you can't really use to trade, but you can use if you understand where price was and can correlate that with COT positioning, and then you can kind of begin to anticipate what might happen next. And so that's kind of why gold is kind of stuck where it is, even though it is $2,550. And that is how it works. I get people on X come at me and say, well, if gold's manipulated by the banks, how come it's gone from 400 to 2,400? I'm like, you're not looking at it like a friggin' banker, right? Bankers just want to they want to capture the spread. They want to incrementally make money every quarter, right? That's how they roll. That's why the old notion, rest his soul, but the notion from Ted Butler that one of these times JP Morgan was going to stand down and make all this money. They haven't accumulated 160 million ounces in their vault because they want to make one huge hit. That's not how bankers, if you've ever met bankers, man, that's not how they do business. They want to make money month after month, quarter after quarter, consistently grow it. So gold goes up, and that's fine with the bankers. 10% a year is what gold's done since the year 2000 on average. Okay. They can work with that. What they can handle is 50% in a year. I mean, we're pushing the extremes here right now at 25. Okay, that's, they're getting underwater in some positions, getting wrong-footed here and there. But when you just incrementally go, or think of them as a retreating army, right? We have this land, and now so we fall back, we build new barricades here, then we fall back and do it again. That's the way to think of the price management, that it moves up in stages. And again, we blew out in March into April. I mean, in a sense, it kind of got overrun a little bit with hedge funds that were short, that were covering, got buy stops as price moved up, and they got a whole bunch of momentum of people coming in. But then it's not surprising that then, we run into this new range where every time it goes to 2,500, straight back down, it goes up, then big red candles again, up, big red candles again. So we're in, as long as the COMEX remains the primary pricing scheme for the precious metals, then all bull markets are going to kind of reveal themselves in this same process of kind of 2 steps forward, 1 step back, where the speculative money comes in, the banks take the short side, you run out of momentum, price begins to tip over, technical indicators start to tip over, the speculative money rushes back out, the banks cover up half of those shorts that they put on. Hopefully you just put in a new higher low, the uptrend continues, something else happens, here comes the same rush of money again, open interest expands, the funds get long and the banks get short, and then they run out of momentum again, and and you just get this higher highs and higher lows. That's how it works in gold and silver, and that's kind of how we're trading this year too.
In today's news recap, Chinese silver demand surges. Is this a calculated move? Gold demand in China has been strong this year, reflecting a broader movement of the yellow metal from the west to the east. But the Chinese aren't just accumulating gold. They have also been hoarding silver in recent months. The Shanghai Metals Exchange has reported a significant surge in silver volume, with prices consistently higher than Western exchanges. The price premium in China compared to the West has been as high as 10%. This signals an extremely strong demand for silver in China. Chinese silver imports have also surged, hitting a 3-year high of 390 tons last December. In June and July this year, imports broke through the 400-ton level. A year ago, import levels were half that, averaging in the 200-ton range. Last year, China held the second largest silver reserves in the world, trailing only Peru. Chinese reserves were reported at 71,000 tons. Peru, a major silver producer, had a silver stockpile of 98,000 tons. U.S. silver reserves were 23,000 tons, ranking 7th globally. If the Chinese can push the silver price higher, it could have major implications for the West, the Post reported. If the price of silver continues to rise, it could increase production costs for a wide range of industries, from electronics to solar panels. This could lead to higher consumer prices and a further slowdown of economic growth as China outproduces the West in electronics and solar panels. However, there is some indication the growth in Chinese solar panel production could go beyond market-driven demand. According to a recent Bloomberg report, the Chinese are producing solar panels at an excessive clip. There is some speculation that the Chinese are engaging in some low-level economic warfare, hoping to put the squeeze on Western economies. Now we'll show you the best clips of the latest interview, but first, hit the like button, smash the subscribe button, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Forever. I mean, that feels pretty good. But oftentimes it's like on the back of, oh God, look at what a mess everything is. It's rallying because of geopolitical stuff, or it's rallying because the economy is going to the toilet and we know no more QE is coming, and all the $2 trillion in new debt, all these things. You're like, oh, I know that's why I bought it in the first place, but God dang, I hate, you know what I mean? So that's always kind of double-edged sword. And the other part where sentiment is really controlled is the people that, like myself, that have always bought the mining shares thinking that it's some kind of leverage to price. You're going to make some extra fiat, And the mining shares just stink on ice. And the exploration companies, oh my God, they're just all little money pits. And for example, I won't say who it's with, but I have because I just closed it out a couple days ago. I had a separately managed little account of exploration companies.
Yep.
And that I'm like, I took some money, put it in there back in about the year 2000, mid 2021. I see, because I'm like, I don't know, when do you sell, and I don't know enough about the geology and all. I'll let somebody else do it. So anyway, it was in a little bit of money. It's 50 grand. So it's not like this is like some earth shattering loss that I can't recover from. But 1st of October last year, I'm on vacation. I'm in Vegas to see U2 at the Sphere, and I'm sitting by the pool, and I'm looking at that account, and it's $33,000. And at the time, Bitcoin was $30,000, and it actually crossed my mind. I'm down from 50 down to 33, and I'm like, screw it. I should just blow this out and buy one, Bitcoin with it. And I don't. Gold then, hey, isn't this great? Gold goes from 1,800 to 2,500. And I finally blew that account out at $25,000. So gold's gone up by 30 some odd percent. And this basket of exploration companies has gone down, which again, it's not the company, not the manager's fault. It's just a really hard industry right now. And so anyway, tying this all back together, there's so many people that are in the precious metals for the right reason, but they want to make some extra fiat with gold mining companies, and so many of them aren't doing anything, or are down versus where they were a couple of years ago or 10 years ago or 20 years ago, that people just feel depressed. They've gotten gold up, but they haven't gotten the miners to go anywhere. And there's a really interesting correlation between silver and the GDX that people should explore sometime. I wonder, maybe that's a way that sentiment gets controlled. But I digress. So I think that's probably sentiment, is that one, you're happy to see gold go up, but at the expense of, chaos and madness. And then your mining shares aren't going up. And it just seems like it's just depressing. So anyway, then to the COT report. Remember I mentioned the gold breaking out and going 10% higher a few minutes ago. This may seem like an hour ago because I've been talking for so long in this answer. When gold broke out on the 1st of March, it was Friday the 1st of March, Fed Goon Waller had made some comments about future QE, and boom, it goes up $30, $40 intraday, and breaks out on the weekly chart, goes up $100 the next week. And then over the course of 5 weeks after that, it goes up another 250. So it goes from 2,100 to 2,450 in 6 weeks. If you just look, again, without getting into the nitty gritty disaggregated report of swap dealers and hedge funds and the like, just look at the category of commercials and large speculators. The the commercials were net short. Okay, subtract the short position from the long position. 141,000 contracts when that move started. They're now 290,000. And by the time the move was done, that 6-week move of $250 or whatever it was, they went from 140,000 net short to about 220,000. So it's an increase of 50%. But now, like you showed, they're now 280 or 90.
What do you think of Hemke's take? Do you believe gold has hit its yearly high as the so-called banksters continue to push prices down, or do you think he's off the mark? Drop your thoughts in the comments and let me know your price predictions for both gold and silver by the end of the year. Now make sure to check out this next video. It's a perfect fit for you. I'll see you on the other side.